The crazy thing is, companies can even pay dividends even if they cannot actually afford to do so. In most cases, they're just trying to keep investors on board because they're pretty desperate. That's why it's crucial to understand the next metric here, which is the dividend payout ratio. This ratio will help you understand whether or not a company can afford their current dividend payment, and it's calculated by taking the annual dividend payout and then dividing it by the company's annual net income. But you can also just search for this yourself instead of doing the math. For example, Johnson & Johnson has a dividend payout ratio of 30.4%. This means that out of every dollar that they are earning after expenses, about 30 cents goes to the shareholders in the form of a dividend, and 70 cents is retained and then reinvested back into the business. Now, a stock like AT&T, for example, pays a higher dividend yield and has a payout ratio of 59.9%. However, that is not always a good thing. If you compare the share price of Johnson & Johnson to AT&T over the last 5 years, Johnson & Johnson has returned 7.35%. Meanwhile, AT&T stock has declined by about 27%. So when you're researching potential dividend stocks to invest in, you always have to consider both the dividend return potential as well as the performance of the underlying share price. Ideally, what you'd be looking for is a healthy yield with modest asset appreciation.